Hello, this is Kyle Green from Mortgage Alliance. I'm here to talk to you today about one of the new CMHC rules as instituted on April 19th, 2010. This rule that I'll be talking to you about is what's called an MQR, or Bank of Canada qualifying rate. What this is the CMHC rules now are going to require a client that's taking a 4-year fixed term or less, or a variable rate, to now qualify on a 5.99% rate as of June 3rd. This 5.99% rate is going to fluctuate. We've actually seen it already since April 19th fluctuate from about 6.25% to 6.1% and now to 5.99%. This rule is instituted to prevent clients from getting into a variable product or a short-term fixed-rate product and putting themselves at high risk. If you're in a short-term rate, let's say you took a 2-year rate and in a couple of years things went crazy and rates had skyrocketed, the Bank of Canada wants to make sure that you're not getting into a situation you can't afford to renew your mortgage if rates were, let's say, 5% or 6% at that point in time. So they're trying to lean towards people taking a little more of a safer bet with a 5-year fixed rate. The same goes for variable rates as well. If you're taking a variable rate, you're going to see payments over the next couple of years definitely rise as prime rises. They definitely want to see that you can afford the payments if prime reaches 6% or so, which tends to be where prime sits in a regular balanced economy. Although the 5.99% rate does seem a little crazy as far as what the average over a 5-year period will be, I think it's supposed to be more reflective of what the maximum payments could be throughout the term of the 5-year mortgage. So we know that for most people that are going to do this right, and if they're going to variable product, setting some money aside while the payments are very low and using that money to subsidize the payments when they start rising, that those people are going to be okay. But the Bank of Canada knows that a lot of people, especially first-time home buyers, will begin to stretch their payments or stretch their budgeting and base it off of rates around 2% and not stock up that extra cash for the inevitable rises in prime rate. And they don't want people looking at their payments in a couple of years not being able to afford their homes. So they've made these rule changes because of this. Although my sophisticated clients and rental property purchases were not too happy about it, because most people are looking at this on an average as opposed to as what the maximum rate will be in the term. But unfortunately, it's a rule we're going to have to deal with. If you have any questions, please contact me at 1-888-531-8890 or Kyle@homelinecanada.com. Thanks.